Hello and welcome everyone. Today's video is about derivatives. Understanding derivatives. Derivatives are financial instruments whose value is derived from an underlying asset, such as a stock, bond, or commodity. They are commonly used to hedge risk in financial markets, as they allow investors to transfer risk from one party to another. There are many types of derivatives, including futures, options, and swaps. In this video, we will explore the different types of derivatives and how they work in more detail. First, let's talk about futures. A futures contract is an agreement to buy or sell an underlying asset at a predetermined price on a specific date in the future. Futures contracts are often used by investors to hedge against potential price movements in the underlying asset. They can also be used for speculation, as investors can profit from changes in the price of the underlying asset. Futures contracts are traded on specialized exchanges, and the prices of futures contracts are determined by supply and demand in the market. When you enter into a futures contract, you are required to make a margin deposit, which is a portion of the value of the contract. The margin deposit acts as collateral to cover any potential losses on the contract. Next, let's talk about options. An option is a financial instrument that gives the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specified date. There are two main types of options: call options, which give the holder the right to buy an asset, and put options, which give the holder the right to sell an asset. Options can be used for a variety of purposes, including speculation, hedging, and income generation. Options are traded on specialized exchanges or over the counter, and the price of an option is determined by several factors, including the price of the underlying asset, the option's expiration date, and the option's strike price, the predetermined price at which the option can be exercised. The value of an option is determined by the difference between the underlying asset's price and the option's strike price. If the underlying asset's price is higher than the strike price, the option has intrinsic value. If the underlying asset's price is lower than the strike price, the option has no intrinsic value, but it may still have value due to the time value of the option, which reflects the possibility that the underlying asset's price may increase before the option expires. There are many strategies for using options in trading, and it's important to carefully consider which strategy is right for you based on your investment goals and risk tolerance. Some common options trading strategies include buying call options. This strategy is used when you expect the price of the underlying asset to increase. You buy a call option and profit if the asset's price goes up before the option expires. Selling call options. This strategy is used when you expect the price of the underlying asset to remain stable or decrease. You sell a call option and collect the premium, the price of the option, but you are obligated to sell the underlying asset at the strike price if the option is exercised. Buying put options. This strategy is used when you expect the price of the underlying asset to decrease. You buy a put option and profit if the asset's price goes down before the option expires. Selling put options. This strategy is used when you expect the price of the underlying asset to remain stable or increase. You sell a put option and collect the premium, but you are obligated to buy the underlying asset at the strike price if the option is exercised. Options can be a useful tool for managing risk and generating income, but it's important to understand the risks involved in options trading. Options are subject to time decay, which means that the value of the option decreases as the expiration date approaches. Additionally, the use of options can be expensive, and it's essential to carefully consider the costs and potential risks and rewards before using them as part of your investment strategy. Finally, let's talk about swaps. A swap is a financial instrument that involves the exchange of one set of cash flows for another over a specified period of time. There are many types of swaps, including interest rate swaps, currency swaps, and commodity swaps. Swaps can be used to manage risk and to take advantage of differences in interest rates, currency values, and commodity prices. Interest rate swaps involve the exchange of fixed interest payments for floating interest payments, or vice versa. They are commonly used to hedge against changes in interest rates and to manage the risk of interest rate fluctuations. Currency swaps involve the exchange of principal and interest payments in one currency for payments in another currency. They are commonly used to hedge against currency risk and to take advantage of differences in interest rates between two currencies. Commodity swaps involve the exchange of cash flows based on the price of a commodity, such as oil or gold. They are commonly used to hedge against changes in commodity prices and to take advantage of price differences between different commodities. Swaps can be a useful tool for managing risk and maximizing returns, but it's important to understand the risks involved. Swaps are subject to credit risk, which means that there is a risk that one party to the swap will default on its payment obligations. It's essential to carefully consider the creditworthiness of the counterparty before entering into a swap. In summary, derivatives are powerful financial instruments that can be used to manage risk and maximize returns in financial markets. By understanding the different types of derivatives and how they work, you can make informed decisions about whether and how to use them in your investment portfolio. However, it's important to carefully consider the costs and risks involved before using derivatives, and to work with a financial advisor or professional if you are unsure about which derivatives are right for you. Thanks for watching.